Okay. All right, let's get started then. Thank you everyone for jumping on here. As a quick note, before we get into the meat here, this webinar is being recorded. We will certainly share this information afterwards to any of you that are registered, and of course, those of you that have joined. If you guys have any questions at all, please note that you do have a Q&A box. Please ask your questions throughout the webinar. I'll keep an eye on it, and I'll be able to kind of go through and answer those questions as we go through. It looks like even just right now, we got a question from Shin. Yeah, Shin, I think it may be on your end if you can't hear us, because we do have our audio working here. We just tested it once more. So once again, Q&A box for questions throughout. We'll spend some time at the end to go through them. If it's relevant for the specific slide maybe we're on, I'll interrupt and I'll ask that question. Please know that you'll also be muted and your video will be off throughout this presentation. And again, as a reminder for any of those that joined us late, this is being recorded and there will be a follow-up with the recording as well as the PowerPoint. But without further ado, let's jump right into this webinar. So what we're going to talk about today, really focused around the financial blueprint for a successful hardware as a service business. And hopefully for all of you that have joined, this is going to be extremely relevant. I know even just in working with a lot of you that are on this webinar, as well as those that may be watching this recorded version, we've been talking a lot around hardware as a service and focused a lot around the technology that enables you to go to market with an as a service business. But the one very important topic that I'm very excited to talk about today with our special guest, who I'll introduce in a second, is the behind the scenes finances that go into supporting such a business model, which honestly, for a lot of the times is, I don't want to say forgotten about, but a lot of the, mainly the linchpin into delivering something super successful for yourselves and for your customers and channel partners out there in the field. And our goal today is to talk about examples, things to think about, and of course, that specific blueprint that you can take home and really begin to work with, hopefully yourselves and our special guest, to really start to execute an as a service business out there for your customers. So quick introductions. For those of you who may not know who I am, my name is Andrew Gross and I run our global sales team here at Excite. For those who don't know about Excite, and we'll talk a little bit more about Excite in a second, but Excite is a full stack, what we call device cloud or servitization platform that really gives you kind of like the technology and the tools to deliver that as a service level business. We do everything from enabling manufacturers to cloudify devices, offering remote support, and most importantly, and the topic of today, the ability for you to commercialize and build a store, and really from a workflow perspective, turn your hardware from one-time sales into recurring monthly revenue. And we're going to talk a little bit about what that looks like from a technology standpoint. However, I do want to introduce our special guest today, and we're really honored to be joined by Matt Trotter, who is the Managing Director of Venture Banking over at Stifel Bank. Matt, can you give yourself just a quick little introduction for the people on the webinar here today, and maybe also a little bit of background on who Stifel Bank is?
Yeah, no, thanks for having me. And I think this is a really exciting topic, one I spend a lot of my time, a lot of my day job working on, and have for many years. So I've been in venture banking for about 18 years. I'd say about 12 of those, the past 12 years, have been focused on deep tech companies that often have kind of a hardware software mix as part of their product. And a large amount of them sell kind of via a hardware as a service business model. And it's been really fun to kind of watch this industry kind of, or this kind of sales model kind of evolve and grow. And I do think it's at a really interesting inflection point where you're starting to see companies really scale kind of with this model. And I've been working with companies, thousands of companies along those periods of time to kind of help them think about financing both from kind of a debt and an equity standpoint. And then just a bit about Stifel Financial. It was founded in 1890. There's about 9,000 employees. It's got three main business units. So one is kind of a middle market investment bank, which is number one for equity deals under $1 billion. We have a wealth management platform for private banking. We have about 2,400 advisors, 400 billion assets under management in that group. And I sit in the commercial bank. The commercial bank, just in terms of kind of deployment of capital, over the past 5 years, we've deployed about $10 billion of capital for venture capital funds, as well as venture capital backed companies. hoping to do more of that and continue to grow. But excited to jump into this topic. I think it is something that as you see companies scale, they kind of have the mindset of, hey, if there's companies, if I have customers and they're buying it, it'll be fine. And it can be a little bit more complex than that. So thank you for having me.
Awesome. Thanks, Matt. So before we get into the financial side of things, we've been saying a lot around as a service and subscription. I mean, it's literally in the title of today's webinar. And if you go to both of our websites, there are locations that talk about these types of as a service business model. But why is it so relevant today, right? Let's take a quick moment, almost like a pause, and kind of talk a little bit about why it's so important that we're even speaking about as a service, why there's folks here joining us on this webinar. Well, the biggest thing that we're seeing, of course, I think we're all in agreement of, is that we are on this cusp of this market transition. And when we say market transition, we don't simply mean for specific industries, specific verticals, or even specific locales. Almost everything from technology to consumer goods to building infrastructure to even the transportation industry, medical devices, all of these different industries are making this transition to a true as-a-service level business, which is turning that one-time sale into recurring sales. And that's just one side of it all, right? As we start to look at the opportunity of taking my previous, let me sell this box into the field, but now being able to not just subscribe to that box, but potentially add premium features later on to that box to sell it out down to my customers, empowerment of my channel partners. I mean, there's a lot that begins to define truly what as a service means to different industries. And we've seen this already start to become adopted by really industry leaders in these different verticals. And I think that's one of the most amazing things to kind of take away from this is that when, Matt, you're seeing this, I'm sure, on the banking side, and we're seeing it on the tech side, is that when we're working with these companies, there isn't necessarily a specific trend per industry. We are seeing, of course, early adopters and these market leaders begin to implement and deploy as a service or subscription level businesses earlier on. But now we're at a stage when we're talking about epic market transition, is that it's moved beyond just the market leaders and into the entire market itself because of demand from the customers. I mean, we can even bring a couple up on here. One big example of Rolls-Royce, they were one of the fathers of this entire process of the power by the hour. All right, they're almost the first usage-based model. And even Apple on here is a great example. Everything from their iPhone to offering renewals and even business essentials recently with their channel empowerment. All of these different types of models, they come to define what we mean when we say as a service. And the unique thing here is that when these early adopters begin to work on it, a lot of it can be self-financed. But when you start to move throughout larger market players, through the general vertical at large, you're starting to see now really the requirement of a banking backer. So some level of financial support to go to market with this type of business model. So what kind of drove these companies to get there, I think, is a big question. And I'm sure that the different customers on the call today are thinking about this as well, maybe experiencing a couple of these different driving forces. But what we saw that really drove these market leaders to get there, and now the general market at large, is the ability to look for economic forces, technology forces, and social forces. And really one of the best ways to kind of break these down is an economic force example is even just in the last couple of years of the supply chain crisis, of finding ways to generate greater revenue off of products that remain in the field without having to fully rip and replace hardware or equipment or machinery. It's a huge economic force that we're seeing in technology and hardware as a whole. Technology forces, right? You can think of this as almost the connectivity revolution, or when IoT became a buzzword just 5-10 years ago, is that now IoT is finally implemented. And then what do we do with it? How do we make money off of connectivity? How do we provide service and support around the connectivity of the devices that has now become a standard in everything that I manufacture? And the last one, which I find actually probably the most interesting, is this social force. Is just simply the consumer themselves, the customer, whether B2B or B2C, you're starting to see a full trend into subscription level mindsets. An example of this can be look around your daily life. you subscribe to Netflix, you lease your car, and you rent your apartment. The fact of ownership of physical items and things and devices is starting to change. And these three together kind of build out this true market force, regardless of industry, that is forcing manufacturers to make this move to as a service. So that's what we're seeing in the market, but not from ourselves, but from banks and banking partners like Stifel, but of course, even industry analysts. And what is missing here now? Well, there's a lot, of course, from the technology to support and get there, and of course, the financing to actually make it attainable. But one of the first things to consider when saying, okay, great, I see these forces. Now I understand I need to get to an as-a-service business model. What you first kind of have to ask yourself is, well, what kind of payment type, right? Well, what type of actual transactional model do I see that fits best for me, my channel, and my customers? And there's a ton out there, right? We threw 6 up here on the screen today just to kind of spark conversation. And kind of to give you an example of a couple of these, from subscription-based models where you're paying a monthly fee for the device itself. So not just paying $3,000 for a device and owning it, but now turning that into a monthly perpetual fee for subscribing to that unit with renewal rates, to things like pay per use or pay per outcome or pay per performance. So physically measuring a telemetry and then billing off of that telemetry. It could be anything from pages printed to the Rolls-Royce example of power by the hour, to finally the last two, which I find very interesting, of freemium and feature enablement. So freemium meaning the ability to start to seed out hardware in the field and let the driving force be your software and services. Let the hardware simply be a medium for enhanced software and services that is really where your revenue is going to come from, similarly to the feature enablement aspect. Get products in the hands of customers earlier, faster, easier, and then charge based upon truly what they're using, on what kind of features they want to enable in that device now and into the future. So this is just a very high-level example of what we've seen as a technology partner in the as-a-service transition, and what, of course, Matt and team have seen from the financial partner in this as-a-service transition. But Matt, I'm going to turn this to you now, because I think a lot of the people that have joined here on this webinar have either understood this, maybe have already felt these forces, or seeing market leaders in these different industries kind of get there, and now they're asking, how do I catch up? Or how do I offer a competitive advantage? And maybe already considering one of these 6, if not tons more types models, but how do we get there? How do we get there? When do we get there? Who do we go to get there? Those are the questions that are asked around how we can make this financially satiable to the manufacturers, the channel partners, and the customers that have joined us. So why don't we hand it to you, Matt, and talk to us a little bit more about the financing models around hardware as a service.
Sure. Yeah. So, and I would add one more kind of market force or kind of driver for like hardware as a service of why it's kind of attractive for manufacturers to go down that mode. And one of those is kind of a shorter sales cycle. So, moving from kind of a big CapEx purchase to a more monthly revenue stream, when you're selling into kind of industries that are slow adopters of tech, and we're seeing more and more technology get into the physical world, into these large industries like manufacturing, construction, agriculture, you see that those are harder to break into, and by having kind of more of a lower barrier to entry to get going, can be a really beneficial thing for manufacturers to deploy in order to get in there. And then there is from an investment perspective, having kind of a repeatable recurring revenue model is attractive from investors as well. And so those are things that I think have made this a very attractive model to kind of go to it. I think there's a whole lot of benefits of deploying this hardware as a service strategy, both from a manufacturer as well as from the customers. And that's why it's becoming more and more popular. The main challenge that happens with this model is the upfront capital needed to deploy the strategy. So, manufacturers are often having to cover the upfront CapEx to put a machine in field and then recoup this, cost over several months or several years. And so they're pushing this kind of working capital from maybe normally a 90-day cycle to a multi-year cycle. And then this problem is often compounded if you're a fast growing company. So it's not uncommon for manufacturers to do a pilot and have an early customer engagement, which then turns into a full blown deployment. And so not, if you were just a software based company and you got a large order, you spin up some AWS instances, and then you're off to the races. And you don't have to worry about how you're going to finance that customer. In this case, you really have to worry about, okay, where am I going to get that capital from now to go deliver on the contract that I just got? The other thing that makes this a little bit more challenging too is there are options for financing this, but they can be kind of nuances. And so there are a number of providers to sort through who often have different lending products as well as underwriting criteria. And so kind of navigating that and figuring out who's going to be the best fit for you can be a little bit tricky. And I'd say that when you think about the lending universe, there's kind of three main axes that folks kind of look at. So the one is kind of, are you a cash flow positive company, or are you an investor backed company, VC backed company that is burning capital? Depending on which side of the equation you are on that, like there's a wide variety of lenders that you could go to or not. The other is around kind of the asset value and kind of how bespoke it is. So in the case of if you're financing something that has a really strong resale value and is really well known in the market, like a semi truck or a Cessna plane or CNC machine, that is something that a certain type of lender could attach to, versus if it's like a bespoke custom robot that is going to be trickier to kind of lend off. And the last is kind of the strength of the contract. Who are you selling to? Who's on the other end? And the history of kind of working within those. And I kind of put it into kind of three main categories of folks that I see kind of financing these types of companies. So one is, on the top is kind of technology-focused commercial banks. I am skewing, this group can work with venture-backed cash flow negative companies, can also work with cash flow positive companies. But in this case, it's often the product is a loan. So it's a loan. You would be purchasing equipment, or you would be purchasing CapEx that the bank would then be financing against. And you would own that CapEx. You would get to monitor, you would get to, do the maintenance and service it how you'd like. But you have a loan on your balance sheet for that piece. And then you scale it up kind of as you grow. And the benefit of this solution is it is scalable. So you can continue as you add more contracts, grow this, exponentially. And usually bank financing is a lower cost of capital. The con of it is it is formula based and can have financial covenants and structure around it to make sure that the business is going to be able to continue to operate. And the other downside is it is a loan on the book. So it as you scale it, you will have more leverage on your balance sheet. And then just the underwriting approach, I'd say this category often doesn't look, as much at the residual value of the asset. It's often more looking at the enterprise value of the company, the contracts that are in place, and the ability of these companies to access future investment. The other category is equipment lessors. And a common product that's used here is called a sale leaseback, where essentially you are taking your product, you're selling it to a lessor, they are now becoming the owner and they lease it back to you. The benefit of this, it can be specific lien, or it's off your balance or off your balance sheet. And so you're not building up a big book of debt. There are specific equipment lessors who really understand assets. So if you have an asset that's well understood, your ability to get financing under that will be greater. And again, this is usually a fairly kind of scalable solution. The downside is sometimes the cost and the IRR for this type of product can be complicated. There's often a buyback provision and different elements to kind of figure out exactly how much you're paying for this can be tricky. And then lastly, I mentioned venture debt funds. Venture debt funds are essentially pools of capital where they raise from limited partners. Because they are not a bank, they have more flexibility around structure and size. They can often go earlier and can be a nice tool in the early days of a company. The downside of them is they're not it's usually a higher cost of capital. And then it's not like probably the long-term way that you want to continue to finance your business over time. It might be a useful tool kind of early on in your journey, but over the length of it, I think that you want to use them kind of for a time and place.
Hey, Matt, we had a quick question that came in about like, and actually maybe just to kind of summarize it for those on here that are thinking the same thing. So like in this slide, it's super useful. I think people are going to come back to this slide after the webinar and look at it. Okay, this is where I fall. This is where I fall. This is where I fall. Here are the features, the underwriting approach, the examples of banks that can work with me. But if I'm a manufacturer, like how do I know where I fit or who is the better? Like, do I need to identify that internally with my own financing team, or is this something that someone like you, or even just reaching out to your bank, can kind of help guide me through what is a better approach?
Yeah. So I think, this is the part that's actually unique and I think great. And I'm happy to brainstorm on this, or there's other kind of firms that can help you navigate this too. There's a group called Overlap Holdings, which helps companies navigate kind of the different financing options. And they're creating a database of kind of, and I'll put that in the chat of, folks that are kind of trying to help this. But I do think you actually want to work with a bank or financing firms early on when you're building your program to understand what the cost and availability is going to be for you. Because in a lot of ways, you want to bake that cost into the offering, into the pricing, into the modeling of how you're going to do. And I often work pretty in depth with pre-revenue companies that are thinking about, that haven't even deployed this strategy, and they want to see a term sheet from me or an indication of terms so they can then go and model, okay, is this the right amount of debt? Is this realistic that I think I can get this? Because it is something when you're modeling your financials and you see that, oh, revenue is going to grow from 0 to 25 million in ARR and I need 15 to 20 million of debt to achieve that. Is that realistic? And what is the cost of that? And what is that going to look like? So having those conversations very early can be really, really beneficial, because you don't want to wait and get that wrong and realize, oh, wow, the capital wasn't available or it cost a whole lot more. And then I didn't bake it into my pricing with my customers.
Yeah, it's a great point. Thank you, Matt, for that. And I think this will be a great slide for people to come back to. And if you can share that note in the chat, and we'll send it, of course, with the recording as well. I think it would be fantastic. And even at the end, we'll talk even a little bit about how folks on the webinar or watching the recording can even get in touch with you a little bit easier through our tech platform. But let's talk a little bit about cash flow in this Haas framework.
Yeah, so I started with lending as kind of the thing that I specialize in and that I work in, but I do think that there's other sources of capital that a manufacturer should consider, and they really work to kind of think about the pros and cons or the trade-offs of kind of flexing on these other categories as a source, or frankly a use of capital, depending on how you look at it. And so I think of, in addition, thinking about how you work with your customers, your suppliers, and equity, which are different levers that an OEM can pull, based on kind of what they're trying to achieve. And I'd say, one, you should be thoughtful about kind of how you push and pull on these different levers, but also you should always be revisiting these levers as you become stronger as a company. So as you have more financial strength, buying power, always be pushing on these categories to improve your position, to reduce the cycle of your working capital. So I think in terms of suppliers, I think when you're working with suppliers, or if you're working with a contract manufacturer, trying to get to as good of terms as you possibly can will help significantly with your working capital. That's going to be hard when you're early on, but getting to a place where you don't pay until the goods are delivered and you have a net 60 or 90 days from that to pay can make you in a much better position of not having to use a lot of debt to finance that 60-90 day gap, or even longer for like long lead time parts. And I think working with supplier to try to get them to, you able to provide them POs, which then they can order long lead time parts, but you don't have to pay till it's actually kind of shipped to you, will help you significantly from a financing perspective. The trade-off is, if you're small, or if you're working with a big well-known supplier, they're going to have a lot of power. So you do want to have a quality supplier, so you may have to revisit these terms as you have more and more buying power down the road. The other is customers. And so, as I mentioned, there's a real positive of selling monthly, and the sales cycles can be very short because you're able to get in quickly. But if you're able to get payments kind of annually in advance, or you're able to get prepayments from your customers, then in a lot of cases you will not need to use financing or debt financing, or you'll greatly reduce that. And so I think just thinking about, what is the trade-off? How much longer is my sales cycle going to be if that's the case? And how can I, maybe I reserve, the monthly payments for a certain category of customer, but I really try to push to get annual payments in advance if I can. And so kind of understanding that and limiting the amount of debt needed as you really get to scale is kind of important. And then I do think equity is an option for companies that if there isn't financing available, it's early days, you really, really want to focus on growth and flexibility. I think equity plays a role kind of for companies in terms of trying to scale early on when you're investing in sales and investing in acquiring new clients. But I think of, always think about your working capital across these four lenses, and always be thinking about the trade-offs of, if I move all my contracts to monthly or pay per use, what is that going to mean from how much I need to get from a lender or use my equity and whatnot, because they're all connected. So this is kind of just some best practices, I would say, or, as I've kind of observed more and more companies transition to a hardware as a service model, these are just things that either make it easier to lend on, or something that I think is a best practice for you to kind of consider. So I'll go through these quick. I think on the first is just minimum contract value. So when you can, I know pay-per-use model is quite popular right now, but when you can, having kind of longer duration contracts, annual multi-year contracts that have minimum contract value. So even if it's a usage-based model, getting some minimums baked in there, trying to limit the ability to cancel these contracts can be really, really helpful for a lender. If you're ending up in situations where it's really just monthly, if they can cancel whenever, if there's no minimum usage, it makes it very hard to finance these assets. So the stronger you can get those contracts to be, the more easy it is to be financed. I think focusing on payback period, I think, the gold standard, or at least what I hear right now, is kind of having a 12-month or less kind of payback period on your hardware as a service model, and focusing to kind of get that as low as possible. So you're not stacking up a bunch of debt and capital that you're deferring over very long periods of time. And so I think really focusing on those metrics is important. I do get a question often on what's too much leverage. So, in that scenario, I said, with a company getting to 25 million of ARR and you have 20 million of debt or 15 million of debt, often investors will be concerned about how much money is going towards leverage, or how much money is going towards debt payments. And I think, typical, just for context, if you're thinking of venture debt or something like that, you're kind of targeting somewhere around 25% of debt to equity. I think with hardware as a service financing, it's okay to take on more. And I think you can scale it up kind of along with your operations, because largely, if you're using the debt, that means that you're growing. So that means that you're selling more contracts. That means you're building more enterprise value. That means that investors are going to want to continue to provide capital. And so I think continuing along that lines is usually okay to kind of finance your business, but you may need to inject some equity along the way to get lenders to be feel like there's the right mix there from a debt to equity. On the deployment and timelines incentives, one thing I saw of the past 2 years is a huge spike in bookings. So a lot of companies were booking new big contracts, but the deployment and timeline were vastly extended. And some of it had to do with the topic below, which is supply chain. But also, when you're selling into large corporations, you want to make sure they're incented especially if you have to go physically onto their site, you have to train their people, that they're incented to get this done quickly, because you're often deploying the hardware, you're working and building, these robots. You then, want to get paid for them. And I've seen, a lot of these bookings bulge, so big bookings, but revenue was lagging significantly. And the ones that did it well had these kind of joint incentives kind of in line, whether it's high level sponsor support within the C-level executives, or if it was baked into a contract, carrots and sticks to make them move forward. And then the last I'd say is, or the last two, the effective higher interest rates. So, back a year ago, when it was, the cost of capital was at an all-time low for a decade, you kind of worried less about kind of how much is this going to cost me to finance, and the cost of capital was a whole lot less. Now, Wall Street Journal Prime is 8.5%, and it does cost more. And so just something to be thoughtful of as you deploy the model of, you're either going to have to pass these costs on to your customer, or it's going to be a bigger burden to hit to your margin if you are financing these big amounts. And then the last thing, just from a finance perspective or a lending perspective, the more data you have on your deployed units, the easier it is for me to kind of lend to you. And so having a good sense of, here's how each individual contract is structured, this is my units in the field, this is how they're being used, because it can get quite complex when you're deploying this model. You have some contracts that are monthly, some quarterly, some annually. You have hardware units spread all across the world. There's uptime. There's ones that are coming in and out of the field when they need to be refurbished or replaced. The more I can have a sense that you're on top of that, the more confident I am to kind of lend against it. And so I think that, that is, as we think of kind of platforms that can help with this, because if you're not using a data platform, then, the challenge is going to be that you're going to have to manually send me that information, which is, a pretty big burden. So,
and I think that's a perfect kind of inflection point to this conversation, and sort of like, where does the technology and finance begin to overlap, and why? Because I could follow all these best practices and begin to structure, my contracts to have, maybe some longer time frames assigned to them, identify very short payback periods, ensure that there's things that deployment timelines are as small as possible. But if I'm not able to prove that, and if I'm not able to provide the data of how many customers, how much they're paying, when they're paying, what is the payback schedule, then really at the end of the day, it's done on a spreadsheet. And like you said, they're going to have to just keep sending it to you. What we're here, and I think this is a great kind of transition into this next topic, which is what is that inflection point between finance and tech, is truly allowing for data tracking to support your financial success. For those that are considering as a service or already deploying as a service, I bet a lot of them are done off of spreadsheets, right? You may have your online store, you may have your, handwritten contracts, but without having a repeatable tool that allows you to go to market with these different types of as a service or subscription or recurring revenue options within an e-commerce store, and at the same time, deliver real-time data back to yourselves as a manufacturer, and now back to your lessor or your financier to showcase, hey, this is proving to me or proving to you the payback period. This is a proof and data that the device has been installed and is being used and is being deployed. So this types of what we call verification of the subscription is really this new world of offering not just best practices, but ideally enhanced and better interest rates and enhanced and better access to capital. And so an example of some of the things here that even just, in our platform does, that any of the manufacturers can leverage as this kind of starting point and managerial software to begin offering and deploying these best practices, are things like the verification of where and when and what my hardware is or equipment is out there in the field. The ability to automate those transactions, so you're not just doing custom written transactions and contracts with different customers, but the ability to make it repeatable. And then that analyzing of the data, not just on how the device is operating, but is it online, proving deployment? Is it being used if it's a usage-based type of subscription model? And then the support. if you're going to go enter into usage-based models, maybe with a startup fee or not, you got to make sure that that device is online. If it's not online, you're not getting revenue. And if you're not getting revenue, you're not going to pay back your lessor. So all of these things combined into a single platform don't just benefit you as a manufacturer, but clearly, as we've been talking about with Matt here, are now going to start to really take a big role in your access to capital and your enhanced access to better interest rates. And I think that's a key thing to kind of take away from here. Now, Matt, one thing before we get to the next slide, we did have a question that came in around, you talked a little bit about usage-based models and maybe creating sort of a minimum contract. What about like startup fees? Have you seen that in your history and working with any of these different manufacturers of being, look, we're going to do it on a pay per outcome or pay per usage based, but we want to offer some level of startup fee or initiation fee into the hardware?
Yeah. So I think like definitely see models where, offering the hardware at cost or like, as a way to kind of make sure that part of it is financed or covered. Also, yeah, I think having some type of, whether it's 6 months of services that's paid up front or some level to kind of help ease the burden for the manufacturer to cover all of the costs. It also, there's a double-edged sword of, having a low barrier to entry to get a customer in makes a sales cycle shorter, but it also makes them less incented to probably really deploy it and make it work. And so, if someone is putting a lot of capital behind it and willing to put some money up front, that means they really want it and they're going to put effort into it. And as a company that has limited resources and you're trying to think of where do I spend most of my time from a sales perspective, avoiding these situations where someone's just going to try out your product for a month or two and bail on it, as much as you can avoid that as possible, I think is good. So I do think even though it may slow down the pipeline, having some level of commitment up front, does show that they're wanting to deploy these, because you're going to need their IT resources and often facility resources, things like that, to kind of make this integration work.
Yeah, it's a great point. And I think, even when I know we're talking a lot about usage based, but it's a common thing nowadays is we talked about the verification to the financier to showcase that things are being used for capital allowance and not just to the manufacturer so they can bill. But one thing we didn't even talk about is just verification of the customer, right? If you're going to get a bill or you're going to be charged for something, I better be able to go into a platform and verify, yeah, I use that device or that device performed that outcome. That is the reason behind this bill, the verification for this bill that I'm receiving. So a lot of great benefits when you're combining access to capital enhanced interest rates paired with obviously data and financial success around a dashboard for your IoT devices. So Matt, let's transition to the next slide, because I think we had a couple of questions that came in that I think the next slide is going to answer, which is kind of around like the scenario. Like what does this really look like when it's deployed? And even somebody asked about like, well, how is my channel involved here? Right? Like I may be a manufacturer, but I sell through someone else that then sells to my customer. So what does this kind of look like, walking me step by step?
Yeah, so I think this is an example of a company. It's a robotics company that I think is doing this well. And I talked about kind of working on all your different working capital sources to kind of make this as efficient of a sales model or efficient of a financing model as possible. So in this case, the customer that I'm referring to is actually the channel. So they have created a product, but they do not manufacture it themselves. They have a contract manufacturer. And so the first thing that they've been able to do is they kind of are able to get kind of net 60 terms on delivery. So and they have their manufacturer that is procuring long lead time parts. They meet every month and they go through kind of what are the POs that are coming. They make sure they have supply for those things. They've also designed their product to limit the number of long lead time parts in general, and made it more available. Then the next thing that they've done is they've been able to get a very efficient installation process with their customers as well as their install team to be able to get from delivery of their robot to when it's installed is less than 60 days. So the nice thing is between the manufacturer and the customer, there's not really a working capital need that needs to be deployed there. They don't really have to pay their manufacturer off until they're starting to bill their customer on the other side. then usually they're able, because they've installed the customer, they're able to finance that contract. That those financing from the lender is able to go back into the customer, and they can then they are now able to kind of use the lending options that I kind of talked about to pay the manufacturer. And so they're able to cover the CapEx costs that was needed to go pay their contract manufacturer in whole for the goods that they had delivered. And then from a customer perspective, they are trying to push for annually in advance when they can. This particular company uses like the monthly fees or the monthly model when it's a brand new customer, or one that is of a certain profile where that is going to really be needed, but it's not their standard. It's not their every time. And so they're trying to limit the number of their monthly. When they are monthly, they have kind of annual contracts that are non-cancelable. And so then that comes back again to when they pay back their loan. One, the loan is much smaller because they've been able to finance a good portion of this through their customer. But then for the ones that are financed, they then take a portion of that monthly payment and they pay back the lender, and it cycles. And this company was able to scale, from $1 million in ARR to 50 million in ARR quite efficiently, was able to get debt financing to do this, did not use equity dollars to finance this. Because of that, they were able to scale quite a bit without raising a ton of capital. Their equity dollars went to R&D and growth. This was the lender was able to take care of all of the hardware as a service CapEx needs that they had with their business.
That's incredible. And I think, Matt, a key thing that you mentioned here in passing, but I think it's important to reiterate, we're using, if you look at the bottom three, right, of the value chain of manufacturer, channel, customer, these are almost, I don't want to say interchangeable, but different scenarios apply here, right? It's not like the lender can only be to what I define as the channel, right? I mean, these can change. Is that correct?
Yeah. So in some cases, some certain companies are manufacturing their own products, so they might be the manufacturer in the middle, but they're, the manufacturer may more be like a supplier of certain parts or whatnot. In certain cases, yeah, it's someone that is manufacturing their own goods but selling it through the channel. So I think the same kind of logic kind of applies to wherever you fit in this cycle.
Yeah, I think that's certainly key, especially in the different industries even that we've worked in that have adopted our technology platform. It's applicable to OEMs, to ODMs, to manufacturers, to suppliers, to channels, to service providers, all down to your ultimate end customer. And that lender kind of side on the top of this value chain can move. But I think the 1 through 6, right, like these steps that are taken, those are fairly consistent. And I think this is a key kind of playbook really to return to in this webinar to understand who's involved when, how and where does the money flow. So I love this scenario. And I think, what did you say again, that the company went from like 1.5 ARR to 50 by using this kind of model?
Right.
It's amazing returns. That's awesome. All right. So, well, what's next? I think that's a great spot to kind of for us to end, at least on the financial conversations, and keep questions coming through here. I know we answered a lot throughout this conversation, and we'll get to some more questions in a second. But what's next is actually engaging with both the technology and the financing and kind of making this marriage happen. And if there's one thing I'd love for everyone to leave here with, right? I don't expect you to kind of memorize the scenario, to memorize the different banks that offer, whether venture banking lending or title leasing or the best practices. This is all a learning process, right? And it doesn't happen overnight. However, what is good to leave this webinar knowing is that both of us, Stifel and Excite, we are working together to make this easier for you and actually combining the efforts between financing and technology platforms. And so even today, within the Excite technology platform, as you are connecting hardware, building out your fleet management system, your customer support solution, your e-commerce subscription store, you now have the option to also directly engage with financing partners like Stifel Bank. So this kind of inflection point that we talked about for data and insights is now not just from a reporting standpoint, but even from step 1 through engagement. So I highly recommend for any existing customers that are listening to this webinar to reach out to your success manager and ask them about engagement with financial partners like Stifel Bank through the platform. And of course, any new customers that are considering this, to really look at this as a service, digital transformation as one holistic approach using a single pane of glass platform, not just for fleet management, but also the integration of the financial support that comes from someone like a Stifel Bank. Okay, so let's move to some questions, Matt. Honestly, we actually covered a lot of these throughout. Let me take a quick look. We got a bunch in here. I think one is, I have two here that I think we have time for. One person asked, how am I able to estimate payback periods? Is that done something with my own internal financing? Can banking and venture lending teams help me with this? What does that kind of look like?
Yeah, so I do think with hardware as a service metrics, there is, unlike SaaS, there isn't like one standard that has been defined by everybody. But when you think of payback period, there's two ways to look at it. One, you just take the revenue or the contract divided into what it costs from a CapEx perspective, CapEx plus install often, and say, okay, how many monthly payments or how many payments till I recoup my cost to install as well as my CapEx to get it in hands of a customer. So, if it was a, $1 million contract or a $1 million BOM cost and you're getting paid $100,000 a month, you would think of it's a 10-month kind of payback period. The other way to look at it is by, instead of just taking revenue, taking gross margin. So, taking kind of, hey, what is the kind of the net, contribution that I'm getting outside of my own costs? How long does it take for me to profitably kind of pay this back? Is kind of another way to look at it.
Thank you, Matt. And I think we have time for one last question. In fact, and I'm bringing this question up only because I know we talked about it briefly in the beginning, but I know I've received this question even outside of this webinar. And it is around the question, or at least around the topic of title ownership of equipment. And kind of what are the different options if either the manufacturer, the channel, anyone within that chain that we discussed about in that scenario, for those that are going to be seeking financing and they don't want to hold title, or potentially what are the options around holding title? How would that look, at least in a conversation and engagement with a bank like yourselves?
Yeah. So I think, if you're looking to kind of get rid of the title or kind of be able to kind of not have any kind of lending on your balance sheet, then kind of equipment lessors and working on that side is kind of really the way to go. And they will purchase your hardware, they will own the title, and they will lease it back to you. In certain circumstances, when you have a scaled product that is working really well and that you're not going to need to swap out a ton, that's actually a pretty interesting model in a way that folks do scale this in. Like that's a more standard, that is a nice way to kind of finance the business. I'd say when you're early on and you might need to swap out your hardware, you're kind of working on version 2, but you might need to get to version 4. You want to have a lot more control of your hardware. And so that's only kind of the trade-off there.
Great, thanks, Matt. I know we were not able to get to all the questions. We will provide answers in the recording and the email follow-up, but thank you everyone for putting in a bunch of these questions. It was fantastic. Matt, if just to kind of close this up, I know we talked a little bit about obviously the engagement with Stifel directly through the X-Sight technology platform. But if anyone would like to find out more information about Stifel, or even just engage with yourself, what are some of the best ways to do so?
Yeah, so probably for me personally, just shoot me a DM on LinkedIn. And again, I'm more than happy to brainstorm around what is available for you, how we might be able to help. And I'm a big believer in kind of supporting the industry as a whole, whether that benefits Stifel today or not. The more successful manufacturers there are, the more they're able to kind of transition into these hardware as a service models. I think it's going to be better for the whole industry. So I'm happy to be a resource.
Couldn't agree more. And thank you, Matt, for joining us. This was an awesome conversation. I knew I learned a lot from this. I mean, we're a bunch of tech guys learning the finance world and vice versa. So it was great. Thank you for joining us. I hope that everyone on the call enjoyed the conversation as well. Same on our end. If you'd like to find out more about X-Sight and our technology platform as it relates to the servitization of your hardware or the SaaSification of your hardware, you guys can go to X-Sight.io. Or again, also, if you'd like to reach out to me, myself directly, LinkedIn is best. You guys can find me, or even just shoot me an email at andrew@xsight.io as well. So thank you all again for joining this webinar. Again, it was recorded. We will be sending this out along with the presentation and some answers to the questions that we did not have a chance to get to. And Matt, again, thank you so much for joining us and sharing some of this incredible knowledge. And for everyone else out there watching this recording or is here to live today, we really do both from Stifel and from Excite. Look forward to working with you on your own transformation from one-time sales to recurring revenue and truly entering this as a service market. So thank you all again and look forward to working with you very soon.
That's it.